Hey, on this podcast, I have Salman Anwar with us today, who's a former tax inspector, and he really spills the beans on this episode in terms of why property investors, landlords, property developers are so interesting for HMRC and the kind of things that triggers those tax investigations as well for property people. We also talk about the differences between tax planning, tax avoidance, and tax evasion as well. So a really exciting episode. Let's head on over and get straight on into the podcast.
If you're going to generate additional income, for example, in a particular tax year and it takes you above that, it starts to not be a 40% tax hit.
Yes.
Marginally, it's a 60% tax hit. So that's the first thing. People don't take account of the fact that tax is a cost. One thing I would say to the listeners would be that do some basic research right at the start. So
have some basic awareness.
Absolutely. So understand what you're going to pay tax on, because I don't know about you, Saj, but when I was younger, I didn't know what I was going to pay tax on when I was going to start earning, right? In my first ever business, I thought it was going to be on everything I have in my bank account. I didn't understand capital revenue.
Salman, really excited about this episode. As a former tax inspector, having you on, I'm sure this is going to be a thrilling episode. I remember beforehand we were speaking about somebody who'd had a property portfolio, about 30 odd properties, never declared any tax, and then HMRC had hit him with like a £2 million bill, and you got that reduced to a significant amount. But we'll talk more about that later on. Just first of all, briefly, just tell us, what is it that you do?
So, firstly, thank you for having me, Saj. It's great to be on your podcast. So I'm a tax advisor, but what does that actually mean? So I specialize in HMRC disputes, disclosures, and investigations. So in a nutshell, I'm a problem solver and I solve historic problems.
Yes.
So my focus is on making sure people who are either in trouble or are suspected of not having paid their taxes, getting them back on the straight and narrow.
Right, so you're kind of tidying up a mess as opposed to kind of doing general kind of tax advice, as it were.
Absolutely. So I very much stay sort of in my lane in that respect. I'm always looking back and fixing problems. What I do allows me to be able to kind of understand things and how people should be structuring their affairs. But at the end of the day, I like to do what I'm good at, which is fixing historical stuff.
Yes. So having worked at HMRC previously, you've kind of have the understanding of what they're looking for, what they want. Yeah.
So it's about bringing that kind of knowledge from having worked in HMRC. It's more about the kind of the outlook on things and how they see things. The rules change quite constantly, such. When I left HMRC over 5 years ago, the rules then are different to what the rules are now, even in that relatively short space of time. So it's not necessarily about that. It's more about how HMRC views things and sees things, and just overall their kind of modus operandi, if you kind of take it as that.
And why do you think property investors are ever so interesting to HMRC?
I think it's look, generally speaking, property investors, landlords, it's always in the news, right? There's always scrutiny on that, in that sort of, if you want to call it a sector of investors and part of the public. The reason is, I think there's multiple reasons for that. A, there's political pressure. There's a housing shortage in this country. And there's always a kind of a drive to change behavior in that respect. It's also to do with the fact there are many people who don't get their taxes right that are involved in property. And it's also it's multifaceted in that way. So it's raising tax because we have a fascination with property in this country, culturally, historically. It's always kind of something that's been aspired to, having the second home, the portfolios, and from then on. And it's an easy way to raise extra tax at the end of the day.
Yeah, I guess even a small shift in stamp duty or something like Section 24 brings enormous amounts of revenue for
absolutely
for HMRC.
A small little tweak. It's intended usually to have a behavioural change. So you mentioned Section 24. That's all about making it unappealing to the individual landlord to buy too many properties. The thought process behind that was to prevent them from taking up the sort of the stock from the market, so allowing more first-time buyers. It's anyone's, I leave it to the listeners to kind of to think about whether that's worked or not. But the whole point was, if you've got so many properties that the property income takes you into the higher tax bracket, we should make it more unappealing to And it leads to a revenue generation outcome. So the taxes have been going up anyway in real terms by freezing the thresholds and all of that. But these small tweaks can have a big difference.
So someone, for example, let's say they're a high earner, professional, 80, 100 grand a year type salary, and they going off to do a property flip. What are the kind of pitfalls that they probably don't consider tax-wise that could impact them negatively?
I mean, simply put, it's the tax impact that sort of, so if they're going to make a profit, and you said 80 to 100,000 pounds, £100,000 in our tax system is a cliff edge. You start to lose your personal allowance. So that's the amount all of us have, but we don't pay tax on. So £12,500 roughly at the moment. But when you hit £100,000, you start to lose that. So every £2 of income, you lose £1 of personal allowance. So now if you're going to have, if you're going to generate additional income, for example, in a particular tax year, and it takes you above that, it starts to not be a 40% tax hit. Marginally, it's a 60% tax hit. So that's the first thing. People don't take account of the fact that tax is a cost. If you're going to make £20,000 in profit, that might not end up in your pocket. That will not end up in your pocket. You've got all of the taxes to pay. But if you're then having that kind of a hit, it might actually be commercially unattractive. So, thinking about whether that's the right way of doing it in their own name, possibly using a company, or is it even commercially viable by the time you're done with your taxes? I've come across several situations in my career where somebody thought they were making money. By the time they pay their taxes, they're in a loss.
And I guess in a situation like that, it's not at the end of the transaction. Let's say you're flipping a property. It's not the end of that. Once it's sold, you're going to pay your tax immediately, because it's further down the road. Some people may not even realize until they're producing tax returns and things, or the accountant's looking at the books and say, oh, this is your tax bill. You think, hang on a minute, that was my profit.
Yeah, exactly. So it's the after the event sort of thing. I mean, I think most tax systems in the world are processed now, check later, but also you pay taxes later on. Now, again, we talked about earlier on about, changes to the tax system and the reasons behind it, especially when it comes to property. Now, one of the recent changes has actually been to bring that tax point forward for property disposals. Now, if you sell a residential property in the UK now, you have to submit a CGT return within 60 days. Now, that previously, if you timed it right, you could have had 12 to 18 months before you had to pay any tax on that by the 31st of January following the tax year. And we're talking about individuals. Now, it's 60 days, but still it's after the event. So you've done your deal, you've got money in the solicitor's bank account, it's about to get transferred to you. They tell you have to do a CGT return within the next 60 days, and you have a CGT hit at 18, 28% or whatever it might be. Well, 24 now. And that is something that people don't plan for, generally speaking. And that's where the cash flow can take a massive hit.
And when getting professional advice in terms of your tax or your accounting, or maybe even how you're going to raise finance, if you're going to raise finance, how all that structuring is going to work, and which is the right structure. In your experience, what's the best time to get that advice? Because sometimes people will ask me about, I want to start property investing. Should I just set up a limited company? Well, I think, well, actually, it's not that simple. It's a little bit more to it. What's your thoughts on that?
I think as with a lot of things, and I've heard you say this as well, right? And it applies to most industries, most things you think about. It depends. Now, if you have someone, you're going to buy your first buy to let. I mean, you probably don't want to get too bogged down around the tax. You should think about it. But you don't. It's about company versus personal versus whatever. It's not always something you should get bogged down with too early on. But at the same time, if you're a sophisticated investor and you've got lots going on, you're going to get some tax advice prior to going into a deal, right? What's your stamp duty exposure? That's going to happen when you buy the property, not when you sell it. Your VAT implications, if you're going commercial to residential, what are you going to do with the VAT on there? Are you going to opt to tax or those kind of things? It gets very complicated. Now, if you've got hundreds of thousands or millions at stake in this deal and you don't get your tax right, you can have significant impact. Now, one thing I would say to the listeners would be that do some basic research right at the start. So
have some basic awareness.
Absolutely. So understand what you're going to pay tax on, because I don't know about you, Saj, but when I was younger, I didn't know what I was going to pay tax on when I was going to start earning, right? In my first ever business, I thought it was going to be on everything I have in my bank account. I didn't understand capital revenue.
Yes.
Interesting, now I've become a tax
But
advisor.
they don't teach you that really at school.
Absolutely.
You get very basic
Yeah.
business kind of acumen, as it were, and finance.
Absolutely, and I think that's something we lack. I think if we did more of that in our education system, I think we would set people up for more success, because tax is usually, if not the largest, one of the most significant costs you're going to have in any transaction,
Yes.
a business, whatever you want to have. So I think having a basic awareness at the start, like what are you paying tax on? How is that going to work out? What are the amounts? How does that fit in with your own affairs? So if you're a professional, like we touched on that example earlier, where you've got a 6-figure salary, for example, if you're going to then take yourself into the additional tax bracket, which is 45%, that's a massive hit.
Yes.
And it has a significant impact. And if it's, for example, a regular buy-to-let, it's actually going to be pretty uncommercial for you at that stage, because you're going to have a negative cash flow, right? Now, that's the kind of thing I think everybody should be thinking about, right? What do you pay tax on? How is this going to impact my kind of, affairs and whatnot? But if it's, if you're going to go out and buy a development property and you're going to have hundreds of thousands of pounds in it, you're going to raise finance and all that sort of stuff, then you have to have a good think about things, for the regular investor, if you go and try and buy a property in a company, you'll know this, it's not straightforward to get your finance.
Yes.
Now, the lenders may not be willing to lend to you. It's your first deal, it's in a company, limited liability. If you're getting private finance, again, it's not that straightforward. The whole company versus personal aspect can significantly impact that. So I think, like you said, basic awareness is a must for most people, and I think that it sounds simple, but most people don't. But at the same time, I think it's not about getting bogged down in it, depending on your level, so to speak, and your experience.
Yeah, and it's I guess sometimes you can fall into a trap of becoming super tax efficient, and even going as far as offshore and things like that. But then you become unattractive for raising finance from lenders that don't want to get involved because they don't like the structure. So it's getting that balance right.
Absolutely. And the thing with that is when you're talking about offshore structures or company and group structures, I mean, something like a UK group structure is pretty vanilla. But even that, even a single company, and if you want to buy a property in that company, you're limiting your liability to your investors in a way. Now, some investors might be put off with that, others may not be, and they might ask for personal guarantees. There's ways around it, but it does have an impact.
Understanding, having that awareness, so you know which is the right way forward for you, depending on where you are.
Absolutely. Now, if you're gonna have, if you're gonna have companies that are based in other jurisdictions, and you're gonna stick a trust above that, and you're gonna do other sort of fancy stuff where people can't follow through to you, then they're gonna be put off by that, usually speaking.
Yeah. And so when it, I guess, it comes to people not paying tax or not paying the right amount of tax, it probably comes from either a case of lack of education, they don't really understand, they were unaware, or it's a case of they're deliberately trying to set up in such a way to kind of reduce their tax. And from a HMRC point of view, what is it that they are looking for? How do they kind of spot these, and how does that become a problem?
Yeah, I think that's a really interesting. So there's a few points to that, I think, if we break it down. So how people end up in that situation where they've, not paid their taxes or are, especially with property, a lot of clients I deal with come from a property background, but I deal with businesses generally. And I think this applies across the board. A lot of times mistakes are mistakes. They're unintentional by their very definition. But they then over time grow into something that's conscious, a decision and stuff like that. Now, it's a spectrum of sort of behaviors, and behaviors is an important point, because that's what HMRC looks at when it decides why you've done something wrong, right? Did you know about it, and so on. So I mean, you have accidental landlords who might inherit a property or might move into a second home and then don't sell the first one, and then from there they might get attractive and buy multiple properties. So people can end up in that situation where, without realizing, they'll end up with income tax or usually income tax liabilities without even knowing. Now, that can only go so far. If you then say 10 years later and you still haven't paid your taxes, it's hard to argue that. I mean, we look at things like economic reality and stuff like that when clients come to me to make a disclosure. Were you making a profit? Did you think you were loss making? Stuff like that, to be able to explain why you took your time.
So sometimes people are not paying their tax because they're unaware.
Yeah.
Another time people are trying to be super tax efficient.
Yeah.
Creative processes are set up to minimize or mitigate some of the tax.
I mean, that's a very topical point or point of conversation in my field at the moment, because there have been a number of let's just say schemes and structures that have been kind of marketed to property investors to be able to, you know, put portfolios into a company, for example, to be able to make it more efficient and whatnot. However, HMRC becomes very interested when you start taking what they would view as contrived steps to be able to achieve some of those reliefs.
Because you're forcing a certain situation to avoid paying tax.
Absolutely. And when it's artificial, that's where it starts to get into avoidance. So generally speaking, you have tax planning, tax avoidance, and tax evasion. I think most people understand what evasion is, people knowingly not wanting to pay their taxes. But that's kind of, it's serious stuff. That's something that could be prosecuted. People can end up in prison for. Avoidance sits between that and tax planning. So tax planning might be putting money into an ISA.
Yeah.
Right. You have an allowance, it's government backed and it's legal and it's there in the legislation, black and white.
Or using a SAS to buy commercial property or something.
Exactly, right? So pensions and all sorts of reliefs that are available, you know, jointly buying a property with your spouse, because and trying to structure it in such a way where the spouse has a bigger liability because they earn less. Those things are allowed and are quite vanilla.
Yes.
In between that is where it gets into, at least by HMRC's definition, things that are contrived, are artificial. So taking certain
the
steps.
tax avoidance stuff.
Yeah, exactly. So we end up in avoidance, and now there are, and people can go and Google this HMRC spotlights and property, and they'll see what HMRC think allegedly of some schemes that are out there. And so, yeah, you have a spectrum of reasons why people end up in these situations, from completely not knowing to the other end, which is deliberately doing something, to the middle where it's either something that doesn't work or bad advice or contrived steps, which HMRC will then say, look, you just did it for a tax reason, therefore you shouldn't have this. And they're very fond of that as the argument. And
I guess in a situation like that, not kind of picking on any one scheme in particular, but generally when you're looking at some kind of scheme to kind of minimize tax, there might have been some barrister's opinion on how this is good to go.
Yeah.
But what people maybe sometimes forget is that's just an opinion.
Yes. Absolutely.
It's not, doesn't mean that's watertight.
Absolutely. And also you got to remember with any barrister's opinion, it's based on the facts and circumstances presented to them. That would be given in good faith. Now, a lot of times what happens, and marketed avoidance goes beyond property and the recent kind of spotlights on what's happening in the property sphere. It's been happening. People might have heard of things like the loan charge, disguised remuneration, contractors, loads of stuff. The most famous one, probably the Rangers Football Club, you know, EBT side of things. Now, that's been happening for a couple of decades now, and the thing with that is it's contrived steps. It's artificial. It's taking steps to get into that position. Now, when that happens, HMRC wants to look at that and go, we're not going to give you that. We're not going to give you those relief, and we're going to counter it, and we're going to come down on you like a ton of bricks, and we're going to change the law. So they take lots of these actions to try and change behavior and collect the tax that they think should have been due.
So with situations like this, how can you get that balance right when you, because most people want to pay as little tax as they can legally get away with, as it were, if that's the right phrase. How do you know kind of what is good advice and what isn't? What should we be looking for when trying to work out, okay, how are we going to structure our business?
Yeah. So I think firstly, it depends on where you are in your journey. Very early on, you probably don't need very complex advice. You should just, you know, you should have a good accountant who's able to do your returns and give you some basic tax planning advice in terms of, you know, perhaps put it in your name, perhaps put it jointly with your spouse or someone else, or individual versus company, or which expenses. Where you get further along from that, it starts to get more complex, and it starts to get harder to see, good advice versus bad advice, because you're relying on the technical expertise of your advisor.
Yes.
Talked about barristers' opinions. As we touched on, is fact specific. Now, if you have a barrister's opinion, ask to see it. Will the advisor share it with you first and foremost? Now, if you're gonna rely on counsel's opinion, you need to be able to see it. What facts are they? Are they the same facts as yours? And like you said, it's an opinion, and it's based on what was presented to them. So if your case is not gone in front of them, you can't really rely on that long term. It probably will be some sort of mitigation, but if you've not seen it, HMRC is not going to take kindly to that.
Yes.
And now, in terms of the rest of it, so you've got a range of different advisors. You can go from your accountant, and even with accountant, it's accountants, chartered accountants, and so on. Same with advisors.
And specialist knowledge as well in property.
Exactly.
They might be an accountant, but they may not be doing much around property, for example.
Yeah, so they may be, maybe have from your chip shops up to your couple of property, portfolio clients, but they're not a property person. I talked about earlier that I don't do forward-looking advice. The reason is because I need to keep on top of it.
Yes.
I have enough on my plate.
Essentially, what that means is you don't do kind of tax advice and tax planning because you're mopping up problems. That's kind of where your specialism is.
Absolutely. And the reason for that is if I did the planning side of it, I'd have to keep on top of that.
Yes.
Things change quite regularly. Whereas when I'm looking at things historically, I know what I need to deal with, take the facts and mold it. Now, when you're looking at specialist accountants, tax advisors, there's those kind of things. Are they a generalist? Are they a specialist? What sort of experience do they have? What are their qualifications? Who have they done work for? And when it then comes to advice, actually read it. A lot of people will get advice. They'll take the headline and run with it.
Yes.
They'll never read the facts. They'll never read what was said to them. As a professional advisor, there's probably going to be a million caveats in anything we write.
Yeah.
People don't normally read them.
Yeah.
Now, so I think judging advice is based on, look, you get what you pay for. It's the level of expertise, level of specialism, level of qualifications, experience, brand, all of that will be an indication of whether someone's giving you advice that's kind of reliable. And ultimately, it could still be challenged by HMRC, even if it's rock solid, watertight advice. HMRC can still challenge it later on. In fact, I mean, there have been plenty of cases where they'll retrospectively change stuff, right? And change the outcome. So it's never a guarantee.
Yes, because I guess even Section 24 is almost like a retrospective thing, because they've kind of gone back and changed how you're going to get taxed based on what you did many, many years ago, as opposed to kind of what we're doing going forward.
Yeah, absolutely. So that one's about, if you've got a property portfolio already, you can't do anything about that. You've already got finance. You can't just pick it up and stick it into a company or refinance or pay, obviously you can pay it off, but there's significant implications around all of that. Now, the retrospective nature of what's happening, sort of kind of outlook on things or kind of looking back at things, HMRC is doing a lot of that. They're doing that a lot more than they ever have in the past. I talked about disguised remuneration. I don't want to bore anyone with that, but effectively, 2019, they brought in something called the loan charge. And basically, if you'd been involved, regardless of whether they caught up with you or not at the time, they said, we'll catch you in 2019. Now, they had to tweak that a little bit because of the scrutiny. And even now, a lot of people are being quite harshly levied with tax charges where HMRC didn't catch up with them. Section 24 is a perfect example for properties. And I'm sure we can think of a lot more if we needed to, but exactly, it's always worth bearing in mind what you're doing right now is based on the law right now. But if there's a change of government, as we may get shortly, there'll be a change of policy, there'll be a change on outlook. Right now the topical thing is around non-dom taxation. So people who are not domiciled in the UK. It's a complex topic, but the current government's got certain plans, but they're now going to get shelved. What Labour are going to do if they come in, or even the Conservatives, they stay in, or if there's a hung parliament, nobody knows. So there's been a lot of advice that's been probably given over the last few months since the budget.
To start planning, because some of these things can happen quite quickly, and if you've got non-doms status, you need to be thinking ahead. How do I change my situation structure? And
usually when there are these announcements, they include what are called, especially when the legislation comes in, they're called what's called anti-forestalling provisions. What that means is stopping people from running and doing stuff in that little transition period where it could be against what they want to do.
Okay.
So the whole point about the non-dom taxation is to raise the tax charges on people who are not domiciled in the UK, live in the UK, but are from, generally speaking, have a home somewhere else and might keep their assets offshore and don't want to get taxed in the UK on everything worldwide. Now, it doesn't make sense for them to bring something in that does that, but then allow them 2 years to set everything up. So it's that kind of thing. But now that's all up in the air. So look, it's sometimes people can get too bogged down around tax. And while, as we've repeatedly talked about, it being a significant cost and it can lead to adverse outcomes in terms of your cash flow, your profits, and whatever you're going to make on a deal, it's important to think about but not get too bogged down on. And it's about getting impartial advice. If someone says to you, guaranteed you can do X, Y, and Z, unless it's simple, that's probably a red flag.
Hey, each and every month we get together with about 200 other people to talk about property investing. We share best practices. We have fantastic speakers sharing their knowledge as well, like some of the people I have on this podcast. So if you enjoy this kind of thing, you enjoy this knowledge, and you enjoy the idea of networking, then you should definitely come along to our monthly property meet in Birmingham. We'll put a link just below here and look forward to seeing you then. And let's get back over to the podcast. So I guess over the years, how HMRC go about kind of collating data has changed significantly, because gone are the old days, everything's on paper, and you look at land registry and say, oh, that's such and such a name and that tax return, and maybe they don't match, or there's a slight difference in the spelling of names or something. But now data is much more abundant, and the way they collate and utilize data is very different. So tell us a little bit more about that.
HMRC has, on any given address, individual, and anything else you can think of, thousands, if not tens of thousands or hundreds of thousands data points that it collects. And a lot of it is now done automatically, as you said. It's all electronic, from your bank sharing that is paying you interest, to land registry, to your credit report, to possibly around whether your tenant's getting benefits or council. Anything and everything you can generally think of, it gets collated into HMRC's computer system called Connect. And Connect brings all of this data together, and it allows HMRC to manipulate it. So in my time in HMRC, we would put in someone's name and details, and you'd get this massive spidergram, which you couldn't print because it would be reams and reams of paper. And you could see from the mobile phone bills they had, to the addresses they'd ever lived at, to all sorts of stuff. Like I said, thousands, if not hundreds of thousands of data points. Now, HMRC goes through that and identifies people based on its risk profiling. So, for example, when we're talking about property, in this space, it's something called the Let Property campaign has been running for over a decade now. It's a campaign that allows people to go into voluntarily to pay their taxes.
This is somebody who hadn't declared
who's not paid
previously.
their taxes, and it also allows and HMRC has also been using it as a way to kind of write to people to prompt them into making a disclosure or investigating. Now, the way HMRC investigates changed a lot. Previously, you would always get like a brown envelope, and it'll have an inquiry notice or something that telling you an investigation was starting. Nowadays, you might get that, or you might also get what are called nudge letters, and they might just say, we have some data, we think you've not paid your taxes, it's related to property or offshore income and gains or whatever, and go fix it. Now, that then gives you an opportunity to kind of go and fix things. So yeah, I mean, HMRC's operation and the way it operates has changed a lot, and kind of the way of fixing it is also kind of evolving as it goes along. And it's very important for anyone who's not paid their taxes to take the right advice to make sure they do it in the right way. Now, if you're a person with a couple of properties, that's generally, Let Property campaign's fine. But if you're someone who's got, and this has happened in the past, 20, 30 properties and who's not paid their taxes, or have got things significantly wrong, that might not be the right route for you, because you have to think about, what are HMRC going to do in response to you trying to make a disclosure? So all of those things become very important when thinking about how to fix problems.
So just to unpick some of that, so a nudge letter, meaning in case, hey, there's something that's flagged up that we are curious about, and you shouldn't ignore those letters, that you should be acting on that straight away. And then it's all depending on the size or complexity of what's happening. it's not just a case of just reaching out to them and kind of giving them the information. You might need the right advice to approach it in the best way to really get the best outcome for you as well.
Absolutely. Look, there are, you know, there are people out there, if they approach well, generally speaking, if you're going to make a voluntary disclosure, it's not in HMRC's interest to prosecute you, but there's no guarantee of that, right? If you've done certain things that fit within the profile, then HMRC, while it doesn't prosecute everybody, its main kind of aim is to get the money into the exchequer.
Yes.
It does prosecute for kind of putting a head on a pole, effectively, right? To get people's attention, to say, right, we can do this.
Yes.
And
it's
time
kind of
to
making
time,
a scapegoat to kind of show everybody else what they're doing.
Absolutely. So it's extremely important, because the other thing you don't know when you approach HMRC, especially if they've not come to you, is you don't know what they're about to do anyway.
Yes.
Right? They might have caught up with you. You just might not have received the letter, or more kind of adversely, a knock on the door in the morning.
Yes.
Right? So if you just approach HMRC, generally speaking, doing it voluntarily is always the best option. But how you do that, which facility you use, which teams you go to, which part of HMRC you make a disclosure to, can be extremely important in protecting you from what can be quite serious consequences, not just financial ones.
Yes. And in terms of, they also run kind of campaigns where they go looking for certain things. Like, for example, they might pick one town and say, right, we're looking for X, Y, Z in that.
Yes.
How does that
so
work?
the way it's so the way that the data gathering works is, like I said, it goes into this massive kind of computer system, you know, servers, databases that kind of compile all of this data. Now, in terms of you know, if we're talking about property in particular, there are you know, there's a particular campaign called, within the Let Property campaign, called the Virtual Street Sweep. This was kind of in papers published by the OECD, Organization of Economic Cooperation and Development, many years ago, and this is something that's been running for years, which is basically, as the name suggests, HMRC will virtually go through an area and look at all of the properties in that area and match all of the data that's available for that. Now, if it matches with Mr. X, who's now not living at that property and living somewhere else, and this property, there's another person living there, well, they're going to put two and two together and think that's rental. So that's one way that they identify individuals who or persons who've not paid their taxes. Another way would be, for example, if you just sell a property and you've not paid your taxes in the past, well, that sale now will get reported within 60 days. You must do it. And they're actively keeping an eye on land registry. So one way or another, you either need to voluntarily fix it, or you will get a letter somewhere down the line to try and fix it.
And these things don't just go away after a few years. They can go back quite a number of years when there's an issue.
Yeah, so HMRC's assessing powers extend, they're based on behavior. If you're someone who's not paid any, or I'd say any tax, or if someone who's not submitted any tax returns, so we're talking about an individual, then HMRC, as a starting point, could go back 20 years. Right? They don't have to really show you deliberately didn't do it or anything like that. They can generally go back. If you're someone who submitted tax returns but has got something wrong, then they need to show either you were careless, that allows them to go back 6 years, or you knew what you were doing, that allows them to go 20 years. So that's a significant period of time. Now, when they do that, it's not just the tax you need to pay. You'll have to pay interest on that. And the current rates are significant, and you'll pay penalties, and you run the risk of them publishing your details as a deliberate defaulter, and all sorts of other kind of consequences from that.
And I guess in a situation like that, most people don't keep records probably beyond 6 years anyway, so they may not know what their accounting was looking like 15 years ago.
Absolutely. And this is where it gets really interesting. This is where other skills other than just tax and tax advice and all of this kind of come into it. So I think, as I said earlier on, I'm a problem solver. I'm not necessarily I don't define myself as a tax advisor. It's about looking at a problem and working out how you get to a solution that works for you and HMRC effectively. Now, like you said, 15, 20 years worth of paperwork, who has that? You know, don't keep anything, you know, more than that. You're supposed to keep stuff for 6 years, but you know, who does that, even that? Now, when that happens, it's a case of trying to figure out, right, what's the best way to model this? What's the best way to kind of come to figures which work for you and they work for HMRC? You know, it probably gives us the good opportunity to talk about the case you mentioned earlier.
Yes. What we started with, the 30 properties.
Yeah.
Yes.
So in that particular case, you know, after approaching HMRC, I mean, HMRC was about...
So just a bit of context again, and to remind maybe listeners. So there's a client that had 30-odd properties, hadn't declared, paid any tax on those for over how many years?
So this gentleman, absolutely amazing guy, very nice. You know, he's not, and most
just
people
forgetful with his tax returns.
Well, I suppose so. I mean, it's very bizarre. This is where it gets really interesting. When I talk to people, they think I deal with kind of, you know, your kind of what your the basic criminal might kind of look like, act like, behave like. That's actually far from the truth, right? Even people who have knowingly done things wrong are generally, in every other respect, quite upstanding members of the community. It's quite bizarre in a way. I mean, I have hardly ever dealt with anyone who you would define as kind of what you would conjure up in your mind as a criminal. They have committed effectively a quite a significant misdemeanor in not paying their taxes. But you know, this is an amazing gentleman on a personal level, really down to earth. Worked really hard all of his life and built up over 25, 30 years a property portfolio that was worth, by the time we got involved, probably over £3 million. He'd bought rundown properties, developed them, and then kind of started renting them. Some he sold. Generally, he was doing it to keep. And then, you know, by the time we'd been involved, he'd gone through close to 40 properties. He still held about 30 odd properties at the time. Now, we approached HMRC and they were about to come to catch him anyway. So the timing was quite right.
Kind of presented, or they'd come up with a £2 million figure for tax.
Yeah, exactly. So after we got through the initial, this is what he's got, these are the properties, and HMRC started to kind of go, okay, if you're not going to go back and do this, we're going to kind of extrapolate. They looked at the value, they looked at the normal rents that might have generated, and they came up with a figure of tax and interest and penalties of £2 million. Not what he'd made. That's the tax. So you can imagine what they were extrapolating he'd made over that period.
And just a clarification on that. So when the tax office comes up with these numbers, they base it on their estimation of from what they're aware of. It's your job to then disprove that might not be correct.
Absolutely. It's their best judgment, effectively. Now, for any technical ones listening out there, I don't mean that in the VAT sense, so just clarify that, but best judgment or best estimate or whatever, they'll come up with a model and say, right, this property would have been rented for this much in this area, and this one times that by, you know, 12, and then time by the number of months, and then times that by the number of years, and you get to X amount, and we'll give you 20% of that as expenses, or while you might have probably made a 10% net profit, whatever. They'll just come up with figures, and then they'll stick that into the tax calculator, and the interest and the penalties lobbed on top of it. Here's what we think you owe, right? And this generally happens when you're not proactively dealing with it, cooperating. Now, in this particular case, we, you know, going back that many years, going back that many properties, it took time. Now, in the time it took us to look into that, HMRC started to come up with their own figures because they got a little frustrated. Generally speaking, if you can control the process, they'll still give you time. And we had that time to kind of go back and go, okay, you think it's that, let us come up with a counter narrative. And then it was similar things. Now, looking back over the properties, kind of, you know, what condition were they bought in? How long would it have taken you to put it back on the market? Now, some of these properties took him 2-3 years to get back into a rentable
state
condition. Licensing, HMOs regulation, all of that sort of stuff. So looking at that, looking at Bank of England's interest rates and many other factors, including like the changes in the property market, we came up with a model. And that model showed he had tax, interest and penalties of around £470,000.
Okay.
Now, so you can imagine this, £1.5 million in the total settlement of a property portfolio worth 3 million, which still had significant, he had equity, but it would have wiped him out in terms of equity if he had to refinance. And you'll know, refinancing.
Or even if he had to sell everything to pay the tax bill, he'd probably be left with nothing by the time he'd paid his.
Then he'll have even more tax to pay on top of that, right? So it's probably negative. And generally speaking, that's what a lot of people who get things wrong end up in that situation. It's the historic bill, if it's not handled properly, leads to them having to sell stuff, which leads to further tax. And it's a kind of a vicious circle, and you end up with absolutely nothing. Now, in this particular situation, thankfully, we were able to negotiate with HMRC, demonstrate what we'd come up with and effectively when we do this, we call it like sort of a business economics model, right? You look at all the different factors, you produce the model, you discuss it with HMRC, they either accept it or they'll tweak it. And in this case, they pretty much accepted it on face value. And the client was still able to pretty much keep the entirety of his portfolio, refinance a few properties, fund it, and move on with his life.
Yes. That's pretty amazing, because you think of on face value, when you look at something like that, I think that's it, that's finished, that business and that person. Absolutely. Yeah.
Look, like, again, and going back to the point is, it's, what I do and people who do what I do, and there's not that many of us in the country who just specialize in this sort of stuff, is we solve that problem from a commercial and tax angle. We try and look at it from different angles. Now, there are lots of other advisors out there that look at that tax and come up with it. For me, where I believe it's really important is to think about the commercials. Now, refinancing a property portfolio sounds great on the face of it, but if you go to any lender and say, here's my whole portfolio, refinance it, and depending on the reason, it's not straightforward, and you might not get a great deal.
Yes.
Right? You might need to do it individually. So one of the other aspects we had to do in this case was not only come up with a £500,000 figure, but also agree with HMRC when it would be paid.
Okay, like a payment plan.
Exactly. Now, this was in and around when kind of COVID was happening, so things were a bit different then. Right now, HMRC are very strict with how long they give you to pay. But generally speaking, in an investigation, you still have the best chance of getting a good outcome. In this particular case, we were quite creative and, discussing with the clients when you would be able to refinance which property and release the funds. We were able to agree kind of a monthly payment plus balloon payments effectively, which is very creative, and it's not something that would happen regularly. But given this particular client's circumstances and his level of cooperation with HMRC, they were happy to kind of agree that. And we I think we ended up with something like a 4 or 5 year plan with stage payments going. He'll pay X amount per month, so thousands per month. And when he refinances the first property, he'll pay you this much, then this much, then this much, which will clear his bill.
Right.
So
that's a very good result for him.
Yeah, I mean, it doesn't happen every single day, but it was, I mean, if you think about in the grand scheme of things, the economics of it worked out quite well for him. I wouldn't recommend anybody tries that way. You'll likely end up in
not the best approach.
Prison. But it's about getting those kind of outcomes, and this is where where the advice.
Your knowledge and experience is what kind of made that.
Absolutely,
made that work.
I think it's and it's just kind of having going through it, knowing the nooks and crannies of what you need to discuss, and building that rapport with HMRC. It's the most important thing you can do.
Yes.
It's not always about fighting them. It's about
them also understanding that you previously worked at HMRC, so you understand the process. Probably carries a lot of gravitas as well.
Absolutely, there's that level of trust that you're gonna kind of uphold that that sort of your background. But don't get me wrong. I mean, it's not there are people out there who haven't got that background and do what I do, and they probably do it as well as I do. However, it's and the grand scheme of things, it's a door opener, and it's a kind of, look, I've been where you are. Let me help you get to a point where this client pays HMRC what it needs to, and we can all move on with our lives. And let's find a commercial solution here, because the last thing you want to do is fire sale and you get nothing, they get nothing. The economics aren't well, tenants get a bad deal.
So, everyone loses out in that situation.
And that goes for businesses as well. Like, a lot of times the conversation I would have is, if you're going to do that for a business, dear HMRC, you're going to put X number of people out of employment. Now, in the grand scheme of things, do they always care? Well, if you've been, depending on what you've done, they may, or they may not, because end of the day, if you've done things that are quite egregious, then they'll be like, well, that's your fault, not ours. But at the end of the day, they don't want tens or hundreds of people out of a job if they can help it.
Yes. So something you touched on earlier is that HMRC's view on things and their kind of policies are constantly changing, evolving all the time. What's kind of driving that? I would have thought they kind of have a general vision of this is what they're doing in that direction. What causes that change, you think?
I wish we had that in this kind of country. I mean, thing with HMRC, I mean, first thing people should understand is HMRC's been through, like with all of the public bodies and departments, massive amount of cuts over the last 10, 15 years.
A number of people I've spoken to worked, I think at HMRC, talk about they're kind of working from home now. There's no kind of big fancy office they're going into anymore. And
I mean, they're trying to change that. So I mean, they did this whole regional office program in and around when COVID was kind of kicked in. Just before that, and it kind of probably was bad timing. And then they had to shift in terms of how big the offices were, and the whole behavioral pattern on where people work has changed a lot. They're trying to get people back into the offices and stuff like that, but it's not easy.
Yes.
But I think generally speaking, they've been under massive amount of resource drain. So if you look at the number of people who work for HMRC 10 years ago to now, wouldn't be an exaggeration to say it's halved.
Really? Wow.
And if you look at the people coming through and the kind of training they now get, it's not what it used to be even 4 or 5 years ago.
Okay.
So it's kind of this whole kind of plethora of things happening at the same time. Lack of funding, lack of investment, lack of kind of, people, experience being drained. That HMRC operates in a certain way now. Added to that, and you talked about like a vision ahead and stuff like that. Well, that's all dictated by politics. It's by government of the day. Yeah. Now, if the government of that day has a certain vision of what they want to happen, then that's what HMRC is going to have to do.
Yes.
It's led by the Treasury.
Yes.
And that's generally it. Now, HMRC internally will have long-term programs and things like that, but ultimately it's driven by political decision in terms of what happens with the taxes, how much investment it gets, the people that it employs and all that sort of stuff.
So I suppose it's creating a bit of a brain drain as well, where people that have been involved in HMRC quite a long time on the kind of tax collection side, they get to a point, they may be becoming a bit disillusioned about the environment and stuff as well, and then jumping ship, moving to the side, moving into corporate. And so they're kind of losing that knowledge within HMRC. Would that be a good analogy?
Describe my reasons for leaving to the point, to be honest with you. I think it's, although probably the experience bit was not for me, probably don't fit that bill, but I've seen it happen time and again. And seriousness, it was looking at that, looking at where HMRC is going, career progression, the disillusionment, how the departments run, all of those things led to me leaving HMRC because it was, grass looked greener on this side, and it turned out to be the case, and that's what's been happening. Now, for other people, it's, who've been there for 30, 40 years, and they were coming up to retirement, they've taken early retirement.
Okay,
they don't want to, they don't want to travel from, from the regions into the main cities, which is where the regional centres are.
Yeah.
If you look at the regional centres, you have Bristol, Birmingham, London, nothing below that down south. Okay. And then you have them in the main cities.
Yeah.
Now, that's 13 regional centres from 150 something local offices. Now, if you imagine, if you're coming up to retirement and you go into your local office to do your work, for example, in the Midlands, you might be in Wolverhampton. Now, if you're going to do a daily commute into Birmingham, doesn't sound so great when you're at the end of your career. Brain drain has been a massive, massive hit. Now, over recent pay reviews, HMRC staff have got a better deal. But the thing is, for 5 to 10 years, they barely got any pay increases. So it was very unattractive for them to stay. The one way to get a pay increase was to jump ship and go work in the private sector.
And I guess in the private sector, the big firms, they're going to be, looking for this kind of talent to come and join them.
Absolutely. And I think it's because, up until very, very recently, HMRC's training was still really great. And it still is in certain aspects, right? If you're on the graduate scheme or the inspector training program as it was back in the day, that's still very good standard of training. The rest of it is kind of suffered significantly, and I'm not doing anyone a disservice. I've spoken to current and recently, departed staff would say the same. They don't feel like they're getting the training that they need. Right. But absolutely, when you look at that, you look at the experience, you look at the unique selling point of ex-HMRC, that fits the bill quite well for some of the larger firms. And again, people don't just do sort of, sometimes my work is, I describe myself as gamekeeper turned poacher sort of thing, and as a sort of almost like in jest, but don't only do what I do. People leave and they might go into tax advisory or compliance or other roles within tax. And again, that's very attractive for the larger firms.
And just before we start wrapping up, in terms of, you said we were probably going to be having some political change happening in the coming weeks and months. How do you think a Labour government might see HMRC change in the coming year or two?
I think it's difficult to see at the moment, really. I think it's more around, people can make their own mind up around political posturing or the need to drive change. A lot of it is around the kind of hot topics that fit with the electorate and kind of the generating the feelings. And I suppose at the moment, understandably so, it's about generating votes and whatnot.
Yes.
I'm not entirely sure. I think what they're going to do and how they're going to see it, but I can say what should happen. What should happen is that we should get a well-funded, well-trained, well-oiled machine in HMRC, because that's what's good for the country. A well-funded, well-trained HMRC that does what it needs to do, keeping people in check across the board, you know, from taxpayers to the profession, you know, accountants, tax advisors, whatever. It's good for the country. It's good for the economy, right? If it can generate and it can make sure everyone pays the right tax at the right time, maybe the rest of us can have a bit of a easing on the burden.
Yes.
But when that's not the case, what we get is HMRC not being able to catch up with people when it needs to catch up with them, or when you're then dealing with certain investigations like I do, you're dealing with it for years on end because the inspectors have got the wrong end of the stick because they don't have the right experience around them to be able to guide them, to be able to show them, no, this is, if a business operates in a certain way, this is probably what's happening. That commercial awareness, that experience. If you work in HMRC, you're in a bubble.
Yes.
You generally speaking, if you started your career there and you've got no commercial awareness, you might not understand how businesses operate, yet you're tasked with scrutinizing them.
Yeah. You've not got the private sector experience. You've always been in the public
absolutely
sector. Yeah.
Now, that would have come through working with people who'd been there for 40, 50 years, who'd been through hundreds, if not thousands of businesses, and, you know, talked to lots and lots of business owners, finance directors, tax advisors, all of that stuff. They would have picked up lots and lots of really great knowledge that they were then applying in their careers, and they would pass that on. Now, so I think what we need is a better trained, better funded HMRC that can actually do the job it's meant to be doing.
What do you think the chance of that happening, considering they've half their workforce?
I think, unfortunately, from the looks of things, it doesn't seem like that's something on the horizon. I mean, in the course of my kind of, if you want to call it networking or kind of being out there, I get involved in a lot of kind of groups and discussion points and stuff like that. We've had discussions through that with say politicians, just say for the moment, and you know, there is an appetite on that sort of that level, whether it's at the party level and whether it's at that policy level. I think unfortunately not. So I think we've got more of what's been happening. I think that direction of travel is going to continue, unfortunately. And I think what that means is it's even more important to make sure you have the right advice and the right kind of professionals on board to assist you, because if you don't, you know, and I've seen this happen, you could be faced with something that lasts for years and years, and it takes you away from your main business.
So just got me thinking about something. HMRC, you don't really see a drive to try and recruit people that are already in the private sector, tax advisors, people like that, to come into HMRC. You don't really see much of that. I've not heard.
I mean, it has happened. It's not. I suppose it's not something that's likely to be out there, very sort of publicized.
It's quite a rare thing.
They don't have the resources to recruit wholesale. Generally speaking, if you hear something in the budget to say HMRC has funding for 100 extra inspectors, what that means is 100 from here get plucked up and put into here, and then you might get some junior staff coming in. Generally,
so
doesn't
most
mean
of his junior staff, they work their way up. There's no one that comes. There isn't really much that comes across other sectors.
They do recruit experience, but again, generally speaking, if you're going in at what typically people might understand as inspector grade, although they don't use that term anymore, but that's one way for people to understand it. If you're going in at that tax inspector grade, in my experience, I could be wrong here, but generally you're going to be paid less at HMRC than you are in the private sector.
Yeah.
Generally speaking, not always the case. Now, how many people are going to make that jump? Who's going to make that jump? And then the other side of that is, there is, again, even if you're experienced and you're professionally qualified, you're generally not going to be somebody who knows how to investigate. So even if you get plucked at a senior level and get into tax inspector, you still need to learn all of that stuff.
Yes, you haven't got the experience, that environment, the internal environment. Yeah.
You if you're trained on this side of the fence, you're trained around sort of technical, compliance, advice, all of that stuff.
Yes.
Which is all great, and that's it's great that HMRC is getting that internally, so it gets an understanding. However, the other side of that is investigation.
Yes.
That kind of nous, that kind of critical thinking, analysis. That's not something that you get taught anywhere. You have to kind of learn that in the job from people who've done it.
Yes. Yeah.
So
this has been a fascinating conversation, and maybe tax doesn't have to be taxing. So, what's the best way for people to connect with you if somebody wants to reach out to you? Because you're the guy to mop up tax messes.
So yeah, I mean, anyone who wants to connect with me, the best way to do it would be on LinkedIn.
Okay.
So if you search for me, Salman Anwar, you're not going to miss me.
We'll put a link up on the screen as well, and also in the description below for people to reach out to you. Salman, thank you so much.
Thank you, Saj.
Much appreciated. Thanks so much.
Pleasure.